Well, chapter 12 is sports business management. We're talking about understanding financial management. So here we go. Again, this is probably for us in the exercise science. This is probably the one of the things in this book that's going to be the most foreign. If you've never run your own business and understanding these different components, because and why businesses run differently. So if you get into the fitness business and you move your way up to management, or you're in areas, I've worked in private business, I've worked for universities, in colleges, at management, different management positions, and so you're gonna, the way they do financial decisions, the way that they report finances and everything it can be different from organization to organization. Sometimes you're like, why do we do it this way? And sometimes the answer is just because they've always done it that way. Sometimes there's a good reason, sometimes there's not. So we'll talk about some different things that you may see. So the big questions is, like if you have your own business or you're managing, is whether or not the business generates enough cash flow to pay its bills. Does it have strong systems in place to collect overdue accounts? Like how do you collect on bills that are not being paid? Club properly budget staff hours based on ups and downs of the business, high flow times and low flow times. What benchmarks do they use to determine their success versus other businesses? Again, we talked about benchmarks when trying to figure out salaries, but we do that again from club to club. Do you have clear established procedures for how you purchase your supplies? I've been at places that do, I've been at places that don't. Does the staff know sales goals? Usually if you have a membership group, they do. Other folks may or may not. And is the non-for-profit status, if applicable, the organization being properly maintained? And will the club have enough money to acquire new equipment when it's needed? These are all things. And so how you go about managing all that is really what they're going to try to nutshell in this chapter. Again, this chapter is not going to give you all the ways to do it necessarily, but they're going to basically kind of talk about generalities of it. So accounting, you've got to figure out, different systems of accounting. So first one is cash accounting that we'll talk about. This is where you only record transitions when you get the money. So somebody pays you in the credit card, somebody pays you with the cash right then and there. Now, if you use POs and things like that, some people use accrual accounting. So they make an agreement. Hey, we're going to give you the service. You write a PO for them. They agree we're going to pay you that amount. Now, you don't have cash in hand. They didn't actually give you the money. They didn't write you a check. You didn't take a credit card payment. You didn't take cash from them. Why would you do that? So again, in here it says accrual accounting provides for better cash management. Accrual accounting provides for more realistic picture of the financial status, and you can report net worth of a club within accrual accounting, but not with the cash base. Now, I would argue it a little bit, I'm one of those that until I got cash in hand, it ain't my cash. Some people you're going to have to hunt down, and you're not going to get the money that they promised you, right? And sometimes you may sometimes you may get money from them, but by the time you use legal systems to get that money from them, you may not get all of it, right? And so that's why, like when they say that it allows for better cash management and is more realistic of your financial, it's not there. It's honestly not there yet. So, you can, I get the idea of, okay, well, this money's coming in, or it should be coming in, so it gives you that idea. But then there's kind of the old school mindset, which is probably like mine, of, until I got it, it ain't there, right? And so whatever you feel more comfortable with, I'm one of those that I'd rather be under accounted for. Now, on the back end of things, when I pay things out, I do more accrual accounting. And why is that? Because if I'm going to pay something out, I want to pretend that cash ain't there anymore because it's going out at some point, right? So, me personally, the way I do my own personal finances, or me personally, the way that I would do my own business finances, just to work on a smaller budget and not work with basically working on credit on the, like, yeah, we'll float this a little bit type of thing. I would run cash base on the receiving end and accrual base on the output, like on the payment ends. And that way it looks like your budget's a lot smaller than it is, but then when money comes in, fine, that gets added in there, and then that's more that again, it's kind of running on a tighter budget if you do it that way. And again, it allows for any it allows for anything that, whether it's a accounting mistakes that somebody makes, or the fact that somebody skips out on a payment, or something goes wrong with a shipment, whatever you're dealing with, you're not, it doesn't kick you in the rear end in the end, right? And again, the book doesn't say that. That's just my personal thing. Financial statements. So we can talk about balance sheets. Your balance sheets are going to have your assets, liability, your equity. So there's, your assets are anything that your business owns that has monetary value. So, it could be your equipment, your building. If you have some businesses have cars, you've got, if you're selling things, so if you're selling supplements, all that stuff is assets, right? Liabilities are anything that you owe, right? So, your current liabilities could be like if you owe on some bills, you're paying rent, your electricity and all that stuff are liabilities. Now, again, you pay them as you go type of thing, but there's still an ongoing liability to an extent. And then equity represents the net worth, right? So that would be current cash, the money coming in plus everything that's owned, right? What's it worth? Now, again, you may not have, some people think, that, equity, I'm sorry, equity is not cash. Equity is like what the owner or the business can claim on the assets of the business. So if, like what's a business worth above and beyond? So like your equity, like if you have equity in the building of the business, would be that, you bought it for this much, now it's worth this much, and so that difference in there would be equity, right? Income statements, they state your profits and losses, so how much have you paid out, how much have you got in. One of the things that people don't think about when they open up a business, or they don't, I think people a lot of times underestimate, is the operating expenses. I mean, this is everything from all the bills you got to pay, just like when you own a home, all, like electricity, water, all that stuff, all the equipment you're going to need to operate, if you got, things like cable and stuff in there, people don't think about that. And then, so everything, just to keep the lights on, the water running and all that, day-to-day operations, you've got towels, toilet paper, paper towels, cleaning supplies, and then you've got all the employees you pay throughout the day, right? That's all operating expenses, right? Cash flow statements, so all the money that's coming in and coming out, right? Again, you can, whoever does the accounting at your business, one of the things that you want to do is compare what you did the previous years to what you're doing now. Is it keeping up with the demands of, property, or, living expenses going up, and like everything else, and you're gonna have good years, bad years. It's one of those things when you look at some big businesses, sometimes you're like, man, they did better last year than this year, or things going south or bad. Now sometimes things have been full a little bit, again, if they made like, if they had profit last year of like several millions of dollars, and this year they had just a little less, several millions of dollars, it's not a big issue, right? Where you're, where things get worrisome is where you were, like you revenued, after all that you had a profit, and then the next year you don't. Those are things that you got to, okay, what do we got to do? What do we got to figure out? And then again, are you trending upward or downward? So you look at last year, you look at the year before, and so on and so forth. So where are we going? What are we doing? What do we need to change, or what were we doing before that we're doing well and we're not doing so well anymore? Or has just things changed and we got to change with it? Budgeting. Budget. It's usually good to be strict on the budget if you can. I mean, again, sometimes big expenses happen, right? We see this in day-to-day life. You're on a nice strict budget, you're saving a little bit, everything, car wreck happens, you're in the hospital, boom, hit with big bills. Happens in businesses too. Pipe bursts, ruins half your, like part of the building, you got to fix it. Piece of equipment that shouldn't have gone down goes down. These things happen. A natural disaster comes through, you don't get all the money from the insurance that you should. These things will happen, and sometimes you got to spend, like overspend a little bit, and that's why sometimes businesses shut down. They'll have one big thing hit and it's too much for them at the time, especially when they're struggling. So again, you create a budget, you stick to the budget, you try to stay, if you get under the budget, you try to readjust, and that's your new budget, and you're putting money away for things, like buying new equipment or replacing equipment, so on and so forth. And again, you need to not only budget, but plan out like when you want to replace things, right? So again, you can do incremental increment and decrement of trend line budgeting. This has to do with overspending, underspending. Like I talked about, you can do break even. So this is your budget. This is usually what I do is here's the break even. Anything extra goes into a savings, right? Anything extra is going into, like future spending, right? Worst case scenario. Again, this is like, especially when you have sales targets and stuff for the month, you're like, okay, if we don't hit any of our sales targets, what are we looking like, right? Again, this is where, like, I think if you do break-even analysis, you create your quotas, you create what you need, worst case scenario happens. Hopefully, if you were saving before, you're covered for a little bit, right? Zero-based budgeting. I don't like zero-based budgeting. Schools like to do this a lot because what happened, or even for-profits like to do this department to department. And what it does is it decentivizes a department to be money efficient. So what happens is they'll say, okay, this department gets $50,000. So if that department spends 40, what typically happens in zero-based budgeting is instead of like giving that department credit that they saved you 10 grand, they now say, oh, well, you can operate on 40. Now you're going to operate on 40. So they just lose $10,000 from like the first year to the second year. So what happens usually in those departments, because they don't like to lose their budgets, is they will spend 10 grand on things that maybe they don't even need. They'll just spend it. Right. That's the problem you run into, is because, they'll report back and they'll say, oh, no, we needed all this. They'll buy things that maybe aren't like super, super important to have. So again, that's the problem with zero-based. Now, if you have an open line of communication that like, look, we want you to do zero-based budget. We're not going to penalize you for saving us. Right. We'll still give you 50 grand the next year, and if you saved us 10 grand, great, we'll put it, you guys, and again, you can do like measure good faith. Anything extra you have, we're going to give you a percentage of that just for your department on top of the next 50 grand. Maybe we'll give you half of it or 25% of it. And that's just for any extra stuff that you may need in the future if you're saving up for things, or you can just give them the 10 grand, say, hold on to that. I know you're going to have some equipment purchases in the next couple of years and things, like however you want to do that, as long as it's open that, no, we're taking that and now you're screwed for the next go round. And that's what happens a lot of times, especially with government entities. This is why, you know, if you look at our city, county, state, federal governments, those entities usually run on zero base. We see this in a lot of state funded universities as well. And this is why our tax dollars get mismanaged, you know, because they run a lot of zero base, right? It's not about saving money. It's about, you know, we got to make sure we get ours, right? Just human nature, you know, people want to take care of themselves, you know, and if you run a department, you want to take care of your department. It is what it is. So knowing that in mind, you can run zero-based budget. You've just got to have good lines of communication. You've got to have some things in place that are going to disincentivize people from being selfish and running up the budget just for the sake of running up the budget. So be careful with zero-based budgeting. I've seen it misappropriated in a lot of businesses. Capital budget versus operating. You have your capital budget, you know, is going to be the stuff like the building, large equipment, renovations and all that. And then you have your operating budget. So that's like everything that, you know, you spend from day to day, right? You can separate them out. Again, you know, you can have the safer rainy day type thing. You know, like, again, you can go to the break-even analysis, and again, you could have different savings. You put things in, you know, day-to-day extras or saving for big things in the capital, that type of thing. So how do you prepare to make a budget? Well, one, you got to gather all the information, everything you're going to spend and everything you're going to need, right? Forecast sales. Again, if you're going to forecast low. You know, don't expect, we're going to be amazing. Now, always look at the low end. Like, okay, like if you're looking at businesses similar to yours, what do the typical low performers bring in? That's a good way to forecast, because then, you know, if you don't expect much, it doesn't, you know, you're not screwed over when you're like, oh, we didn't hit that, right? You know, again, project profits and losses. Again, I would project higher losses and lower profits. All right. Compare against industry norms. Again, I would, you know, like I said, always put yourself in the worst case scenario. You know, just if you'll always do that and prepare for worst case, prepare for worst case, prepare for worst case, and run your business like that. When things are good, you can expend out and, you know, let the purse strings a little bit looser and things like that, you know, don't go crazy, but, you know, being able to be like, okay, we can relax just a little bit, you know, it's better to do that. And then determine your capital needs. And then again, make sure that you're going to budget for those. Again, forecasting sales, like I said, people are never 100%. You know, like if they're 100%, they got it by luck. You know, nobody's really ever that good. So again, forecast sales low. Just look at the trends, figure out, you know, based on everything, this is where we should be. Or you're like, here's the middle ground. Let's look at the low. That, you know, again, profit and losses, benchmarks, right? So how do you figure out if you're opening your own business, you never run one like that, and you look around at the market and see what it costs, see what people are doing. And I mean, that's, you benchmark it. You know, you've got to create your methods and guidelines that you're going to follow. And again, these are not set in stone. They're not 10 commandments. These are things that are going to be tweaked and manipulated to change slightly over the time, sometimes greatly when things are really out of hand. You know, again, they talk about documented assumptions. Assumptions are never good, but you kind of have to, especially when you're first starting a business. So, you know, try to, you know, don't do ideal situations. Always go back to the worst case scenario. Staff involvement. When you're trying to figure things out, don't try to take it all on yourself at the upper levels. And again, some of the folks are on the front line of things, and you know, those are good people to like pick their brains about things, because they're the ones that say everything day to day, right? You know, again, incentives. Sometimes I like this and dislike this. Here's what I like about it. Like when you give department heads, hey, if your department's making money and doing all this, you give them a little bit of kickback where, you know, they can disperse that amongst their employees and they get raises and things. You know, like that's good, um, as long as they don't do it based on the sake of the future of the company. And you say, and some people are like, well, how is that? Because again, sometimes people will make a sale when it's a bad sale. And the reason is because they want to hit that quota for the month so they get their paycheck. You know, they get a higher paycheck. But in the long run, that sale is going to come back and bite you in the butt. And again, when especially in our industry where we're selling memberships to people, don't sell somebody something they don't need, and especially at a price that's well above their what they're budgeted for. It's going to make them unhappy in the end, which then again, unhappy people cause you more problems. You know, they're going to go around bad mouthing your business and you're going to lose business on it. So that's where I see a downfall sometimes, is that you know, and you see this where people, you know, like, you know, y'all been around pushy salesmen, you know how it is, you know, like you can tell that they don't care. They're just selling to sell. And so again, training your staff to understand that sometimes taking a loss is actually winning, you know, and teaching them that, like, you know, how to take a loss so that you can win. Um, if you can do that and you have a good staff that understands that, then yeah, I'm for the incentives. Um, Accounts receivable. Again, this is when businesses owe you money. You know, you got accounts receivable, accounts payable. Um, like I said, don't count what's coming in as it's there yet. But on the other end, count what's going out as it's already gone. The best thing I can tell you on those, right? This book's going to be a little bit more like, oh yeah, you know, that's money in hand. It's not, right? It comes in when it comes in, and that's when it's in. You know, and again, you might say, yeah, but the other money hasn't left. Yeah, but if you're a good business person, you pay your debts. So that's a given, right? I'm not even going to go there. ETF. Um, Again, you got to determine, you know, if you're making a lot of credit card stuff and things like that, you're going to do ETF. And yeah, sometimes you don't get the full 100% because you got to pay fees on that. In this day and age, you kind of have to. All right, so whatever it is, just try to find the best ETF management software that's going to give you, you know, they won't take, you know, they take the least percentage off your credit card purchases. Um, Again, expense management, that's, you know, stuff going out, make sure you're on top of that, you know. Depreciation, right? There's certain, you know, so you buy equipment, right? All your gym equipment depreciates. You know, I mean, it is what it is. You know, the only thing that's going to appreciate that you're going to buy that's big purchase, probably the building. Everything else you're going to buy is going to depreciate. So again, just understand that. Understand that there's usually that cutoff point where it's a good time to trade in equipment because you still get like a decent value for it to buy you some new stuff, right? And so you got to look at that because there's a point of no return where it's not really worth trading it in for what it's going to cost for the new, right? There's this, and again, you're going to have to trade it in, and you're going to have to be like, man, you know. So again, it has to do with sometimes the warranties and everything else. So just make sure you're on top of that. Make sure you're budgeting for when you're going to have to make purchases. One of the good ideas to do is set up a yearly, you know, again, you know, this is last one of the gym that I was working at. So what we would do is, you know, certain things have 10-year warranties, certain things have 10-year. We kept a Excel file with all that. So as soon as the warranty year was up on things, we had already planned out, okay, that's the year we're rebuying treadmills, or that's the year we're redoing our benches, or that's the year we're redoing, you know, some dumbbells or some cycling bikes or whatever it is, you know. So you got to understand that, and then there's certain things that, you're going to let them go past their point. Like if you have a piece of equipment, like a bench or something that's just holding up or things like that, and it's got no real wear and tear on it. And if you can it may be worth getting a few more years out of it, and doing that, maybe if you have to refurbish the padding on it or something, you do that, right? As long as it's not going to be a safety issue, you're good to go, right? The other things you got to think about are your taxes, right? Understand all the tax laws that are going to apply to you as your business, right? So you got to understand that. You got to understand how you want to file your business so that you have certain tax codes and things like that. More than likely, if you're going to start your own business, it's a good idea to have an accountant involved in creating the business if you don't know these things, right? Just don't figure it out as you go along. It is a bad plan. But that's it for 12. If you have any questions, we'll go over it live. All right, see you.